All right. Hello, everyone. Thanks for jumping in. We'll go ahead and get started a little bit while we wait on folks to come in. This is our Fireside chat series, and we're joined by Fred Tuomi. Fred, thank you so much for jumping on today.
My pleasure. Great to be here. Thank you for the opportunity.
Yeah, and I'm sure Fred's name is likely familiar to most folks, but by a quick background, Fred is the former CEO of Invitation Homes, which was the nation's largest single-family home REIT. Prior to Invitation Homes, he spent 20 years as a executive VP and president of property management for Equity Residential, the nation's largest multifamily REIT. And just has had a ton of success and experience in this industry and having an impact on the way people live and experience housing. And we're also lucky to have Fred as an investor and arrived, and excited to jump into the conversation today. Great. So Fred, before we jump into the real estate career, I'd love to learn just a little bit more about your background. What was growing up like for you? Anything that comes to mind there.
Growing up, well, I've never been asked that before on an interview. That's a dangerous question. I had kind of an atypical childhood in that I was always kind of an independent free thinker. So I just wanted to be by myself most of the time, not at home. So I was always on the run, on the go. I worked starting from the fourth grade. My older brother had the largest paper route in our little town, and then he got tired of it. And I was helping him every day anyway. In fact, I was doing most of the work. So I took it over on fourth grade and kept it going until our family moved. And then I immediately found another job. And then through high school, I was in the work release program. Our high school had a program, I forgot what it was called, distributive education, where you could have a career at the same time going to high school. And I thought, wow, that sounds like something really cool. So I did that. So I was able to work almost 40 hours a week while still going to high school. And I was in Atlanta then, so I worked at the Atlanta, one of the most prestigious country clubs in Atlanta. And that made Caddyshack look like choir boys. So it was a lot of fun. I grew up quick, learned a lot of skills there, some of which my parents never knew about. And but I did great in school, made basically straight A's in school. And then I got married very young. I was 19, had a child right away. And then I was kind of like maybe in the early days, kind of like the hippie type, back then, having fun. But I was always working. I wasn't a loafer. And then I always did great in school, great in college. And then all of a sudden I fell in love with technology. And I was trying to think what my college major should be. And this was back in the late 70s, mid to late 70s. And, technology was just getting started. So I actually got one of the very first computer science degrees. And that was kind of the beginning of my career. So I was still working as a kind of a science geek, first for the university, then the Federal Reserve System, while I was still finishing college. And that kind of got me started in technology. And then that led to real estate. But my whole career has been kind of the intersection of real estate and technology. Yeah. Oh, and for the audience, if you hear something pounding, that's not me like knocking my head against the wall. I just moved into a house and they're not done yet. And so I have multiple trades here, and I told them to try to hold it down, but not stop work, because I don't want to stop the work.
Yeah, that's real estate. And yeah, Fred, so interesting, because I feel like at least my, where I had intersected with your career was really on the real estate side, and you've had such success there. I was surprised in hearing some of the past interviews that actually your foundation was more on the technology side, and you were really early to bringing software and technology to property management and to real estate. Would love to hear a bit more about that.
Okay. Yeah, I loved technology. I was a hardcore systems developer, a coder. And back then we didn't have all the cool, fancy productivity tools that programmers have today. We had to do everything with a hammer and chisel. But I loved it. And I worked in finance with the Federal Reserve System first, and down in the computer basement, because they kept us in the basement, kept us hidden. and developed the very first electronic fund transfer program. Because before that, they would run around with little slips of paper between banks and transfer millions and millions of dollars. We worked on a very large program. It took us a couple of years to actually automate it. Then I got tired of working for the government because their pay scale was pretty low. And so I switched to doing hospitals. And hospitals were all run manual by paper and pneumatic tubes back then. And we invented this really cool system and then got a government grant to automate hospitals. And that company grew very rapidly. So we kind of automated businesses that never used computers before. Because nursing stations never had monitors. They never had printers. None of the departments we even had to do the morgue. It was some interesting stuff with morgue, cafeteria, surgery center, ICU, radiology. We did it all. Then all of a sudden I got a call. I was working for a consulting firm, worldwide consulting firm called Computer Sciences Corporation. And I got a call from my boss said, hey, we got this real estate guy who wants to think about putting computers in real estate. And says, wow, okay, I'm up for anything. And sure enough, my first mentor in the business was this man named John Lee Nielsen. And he was a visionary. And he was already operating the largest real estate portfolio in the country of apartments. Had like 100,000. Someday, computers are going to rule the world. And this was in the 70s, late 70s by now. And he said, not just in the basement, running miles and miles of this green bar paper for financial statements, but in the hands of people.
Oh, Fred, I think the audio may have cut out a bit on your end.
As I said, about a year as a little whippersnapper, interviewing everybody in operations. I interviewed maintenance techs, leasing people, on-site property managers, people in the regional office, people at the home office. I understood everything that was done. We put it all on paper. It was done by and saw the interrelationships.
Can you hear me?
By talking to people and diagramming it. And then I conceived how to put it together with the system. And then I hired programmers.
Oh, yeah. Fred, I think we lost your audio. We'll try to get it back here. One moment.
Oh, shit. Can you hear me now?
Yeah, it almost seems like it connected to external headphones or something else.
Oh.
There we go.
Okay. Can you hear me now? I
Yes.
don't know how in the hell that happened. And I don't know when it happened.
Yeah, you had started to talk about where kind of your technology background met property management, and that's where it kind of cut out a bit.
Okay. All right. So I'll I don't want to repeat. So anyway, this guy had this vision to automate, all these properties, and I designed it and I developed it. I hired some programmers. I did a ton of the coding myself, and we actually implemented on like over 400 properties, and it was all done with dial-up modems and these big clunky. The PC had not been invented yet, so we had these big clunky. We took data entry computers and converted them into PCs, basically, not knowing what we did, and it worked like a champ. No hard drives. It was all on floppy disks. And then finally, the microcomputers came out, and we converted it to CP/M on microcomputers. And then PCs finally came out on floppies. And then the PC XD came out with a 5 megabyte hard drive, and we thought that was the end of it. So we continued to refine it and enhance it. And then we started selling it to other large property managers, and it became very popular. Then, probably a mistake, but at the time it was the right thing to do. We sold it to this little company called RealPage. And it is, to this day, it's the kernel of their system, of their apartment management system, is the little thing that I designed and helped develop. So that was kind of the apartment standard, and still is. And then at that point, I could have gone with them, or I could have stayed with my mentor in real estate. And he convinced me to build a career in real estate, and thank God I did. But I was always involved in technology aspects of making it operate better, more efficiently, more productive, and where we could outperform, the competition. So he gave me all sorts of great education. He let me operate all through the company. I was in charge of accounting, of finance, HR, marketing, sales, and then finally I got my own real estate portfolio. And then we kind of rode the wave and rode the market ups and downs. I've been through several crashes, and that's very painful, but you learn a lot. And then many of the upswings, which are very thrilling. And then one thing led to another. So I mastered the apartment business. Then I went big time with Sam Zell in Chicago on the public arena, and then retired, and then went to the single family realm.
Yeah, I think that's a really interesting aspect, is the cycles from, the multifamily apartment business, then kind of take two with equity residential, and then on the single family path. And then, to that point, being a foundation of property management software. I think RealPage is probably the largest property management software company by market cap today. You probably still have code in the code base from your your early days.
Right.
Do you think that property management software was an important aspect of kind of take two in multifamily, in equity residential? Did that play a big role in the kind of philosophy of that business?
Yes, because I joined equity residential in 1992. I was with Post Properties in Atlanta, kind of the premier quality operator in Atlanta, but they were small, kind of limited to Atlanta, and then they had branched out to Tampa, Orlando, and DC. But to have the opportunity to to be part of the Zell empire and to grow big, they approached me. That's a whole nother story. It kind of happened by accident. A snowstorm in Chicago was involved. But my life has been nothing but one serendipitous thing after another. I've never interviewed for a job, and things just kind of fall in place. It's just by magic. And sure enough, I had no idea who those people were. I was stranded in Chicago because it was my first time ever to Chicago. Never been there. Got stranded because of a snowstorm, and then ended up having lunch with the CEO of Equity Residential. So anyway, 2 weeks later, they called me and said, "Okay, we want you to come to work for us." I said, "Oh, I ain't moving to Chicago. I'm an Atlanta boy. I like the warm weather. I don't want to go there where it's like living on the North Pole. I just got snowed in there. No freaking way." And so about 2 weeks later, I agreed to do it and moved my family to Chicago. And it was quite the adjustment. And but it was one of the best things we ever did, professionally and for my family. So anyway, as soon as we got there, we thought, okay, we're going to grow big. There's a huge opportunity at that time. You could buy apartment buildings 40 cents on a dollar. So I remember them telling me, okay, we're going to load your truck. Get ready. Just make sure you're ready to do it at large scale. So I said, well, I have to have systems. And they had systems, but they were kind of clunky, kludgy, not seamless, not easy to operate. And my whole orientation, because of my beginning of it, was I put myself in the shoes of the frontline people, the people fixing the toilets, the people answering the phone, the people signing the leases. What do they need? Because if they're productive, we're going to make more money. If they're struggling, then we're going to make less money. So it was lacking in that area. Good on the back office, good on the accounting, weak on the front office. So we said, okay, we have to basically replicate what I'd already done, because the spirit of equity residential is still there, but it's changing a little bit just recently, is we like to do it ourselves. We want to be in control of our own destiny. We want to own everything. We want to develop it ourselves. So we basically developed it again. And a lot of that, we used MRI as the base, but we modified MRI so much, even they couldn't recognize it. And we truly have and still have at EQR the finest multifamily operations. It's total end-to-end, seamless, every aspect, including all the sophisticated things we added later, such as yield management, revenue management, all these other things, plus very sophisticated CRM and customer analysis, customer studying, and marketing and sales. So that was very, very important driver of the success, because when you operate a large portfolio, every nickel and dime matter because of the leverage you have. And the larger you get, the harder it is to make percentage gains just because of the size. So you have to always be, sharpening your saw and making stepwise refinements. And so that was a culture of the company. Everybody has to be thinking. Everybody has ideas, contribute, collaborate, communicate, collaborate, execute, and have fun while you're doing it. The culture there was one of fun. We enjoyed each other. We had a blast. We had tons of problems, but we would laugh at ourselves and at each other and at the world, and we'd get it done. And that went on for 20 years, and I really enjoyed working with the people. I'm still friends with them, still kind of invest in other ventures with them, the ones that have retired. EQR is a customer of some of my ventures that I'm investing in now. And then Sam Zell was very tough. He was extremely tough. To the outside world, people feared him and thought he was like a nutcase. But very shrewd, very smart. People feared to be on the other side of the negotiating table with Sam. But inside, he was very, very tough, very demanding, suffered no fools. But if you do your job and you contribute and you're part of the team and you're a thinker and you're not afraid to say what you think and you execute, it was fantastic because he treated you as a partner. So a true meritocracy is what it was, but the culture was truly special.
And what year was this when you were getting started with Equity Residential?
I started in like 92, maybe January of 93. And then I retired in 2012.
Great. So early on there, it was kind of the formation of the real estate investment trust as well that,
Exactly.
played a role in just kind of the opportunity maybe for that business.
Mm-hmm. Yeah, Sam was basically the grandfather. He was the original sponsor and driver of the whole REIT. REITs existed before, but they're mortgage REITs, just financial REITs. They didn't have property operations and ownership REITs. And he conceived the idea and pushed it through Washington and legislature, IRS, and then he created the National Real Estate Investment Trust, associated NAREIT, and got it going. We went public, EQR, as a public REIT. Our total market capitalization was only 500 million. Yeah. So back then it was like very small companies going public, but it gave us a tremendous, two tremendous advantages. One of them initially was why real estate sponsors wanted to do it was you could get off of personally guaranteed debt. Because back then, if you borrowed money, you had to personally guarantee it. Even though it's for a business, you had to personally guarantee it. And that made a lot of developers who are becoming big, had millions, hundreds of millions of dollars of assets. A little nerve-wracking when you go home at night and try to sleep and you're personally guaranteed all this stuff. So they wanted to get off of that. So the public vehicle, was a good thing but people didn't talk much about that. But the real reason was, it gave you access to massive capital. And it was perfect timing because there was disruption in the real estate market then. A lot of foreclosures, a lot of brain dead assets. The economy had been tough, but now it was getting better. So it's the perfect time to strike. And we had access to basically unlimited capital. We could raise hundreds of millions of dollars overnight. Now, not in the early days because we had to go through rating agencies and we had to do all this other. But later, when we had publicly rated debt, I remember our CFO, David Nethergut, we raised $500 million from 4 o'clock in the afternoon, is in the bank 10 o'clock the next morning. It's just, and then you could issue more equity. So we grew that company from 500 million to about 22 billion when I retired. Then and we went from 6,000 units. Sam and Barry Sternlicht, you probably know that name, contributed their assets that they had bought from the government through failed savings and loans into the initial portfolio. So we had about 7,000 apartments, and they were ragtag, crummy little deals all over the place, pretty much southeast. And then into the premier portfolio of, first of all, we grew like crazy, and it got up to I think 225,000 apartments. And then we consolidated down to just the premium locations, premium markets, premium assets, down to about 100,000, and then it went a little bit less but in a much smaller footprint, but the value of the company was much greater.
What was the push that brought you more towards the premium apartment class at that point?
A couple things. There's the financial reason, especially as a public company, but I think it really applies to any investor. You pay a premium for quality. In any product, in any form, life form, anything you do, there's a premium ascribed to quality. Commodity is, by the definition of the word, is just average. So you don't get any kind of a special, pricing or valuation. People could take you or leave you. Or if you're at the bottom, it's a discount because it's fraught with risk. So same thing can be applied to the basket of assets to invest in with real estate. Now, returns also, inversely correlated with that. The higher the premium, the higher the asset, the lower the return, but the more stable it is, the more predictable it is, and the most important thing, you get growth. At the low end, it's very tempting because you're going in, cap rate is high. You say, oh, look at these yields. How can you pass that up? Well, my experience is through thousands and thousands of them is that yield is baloney because you'll never achieve it because operating those properties is a lot more difficult. You have more operating expenses. You have more labor because of more management intensive. You have more skips, more evictions, more turnover, and a lot more CapEx. And the repairs that you make are more frequent and more expensive. So you pay a price later. So the returns are probably equal at the end of the day. And if you have a portfolio, you can take a discount on that because it's perceived as lower quality. Premium, it's easier to operate. So as a property manager, most of my career, the selfish one was so much easier to deal with stable resident base with high income qualifications. So you have less issues with delinquency, fewer evictions, very few skips, and then, the pride of ownership is greater, unfortunately. And it's just a fact, your move outs aren't as expensive to get back, the turnover costs are lower and the CapEx is lower. But then the interesting thing on the public markets, you're concerned about your share price. Okay. Yeah. Day to day, quarter to quarter, year to year. Versus like, which my NAV. NAV was kind of an interesting measure and sometimes correlated with the share price, but share price. So you're valued really on a earnings multiple, no different than like the S&P earnings multiple or any corporation earnings multiple. It's a multiple of your free cash flow, FFO multiple, which is basically NOI after done some adjustments. So the market, the street, especially the real estate investment trust investors, they value companies and rank order them based on the perceived quality of the properties, therefore the perceived quality of the income stream, therefore the perceived quality of the growth rate in the future, and the perceived quality and stability of the dividend in the stock. And therefore your FFO multiple is higher. You could get say for example, at any given time, a 21 or 22 multiple on a premium company, whereas a low-end company might get high teens. And that's very significant as your charge as a manager in a public company is to build shareholder wealth.
Yeah, it's interesting to hear you talk about the differences between the different segments of real estate on the lower end and then the higher end. I think some of those are lessons learned on living the pro forma out, because I think a lot of times you can look at a pro forma yield and be very excited about the potential, but you've lived through multiple cycles of seeing the results of those pro forma models and the benefits that can be ascribed to that premium segment. It's very interesting.
Yeah. Now I know some people out there may be like, wait a minute, I know I can make money. It is true. Okay, you can make a lot of money dealing with lower quality assets. Absolutely. I've known people who've done it. They're doing it today. They'll continue to do it in the future. Is it more difficult? Yes. Is it for everybody? No. And some people say, well, that's why I want to go there. And I like that idea. Go where it's difficult. Go where no one else is. So you can make money at the low end. I'm just glad I did operate very, very low end, scary, where you need a police with body armor patrolling the properties. I did that in the 80s. That was not fun. But you can make money on those. And a lot of it is fee driven. So especially as a property manager, you can make money on those because the fees are lucrative.
There's more work involved.
And if you hook that up with the government programs such as Section 8 or all these other housing programs, whether they're local or regional, statewide, or federal, there's a lot of fees that you can earn as a sponsor and as an operator. And so those businesses are, again, not easy, but you can make a lot of money in them. And then the investors, if it's a low income tax credit deal, there are incentives. The government has incented investor capital, risk capital, to allocate risk to this sector to stimulate some affordable housing, which makes good public policy sense. So, but that's just proof right there. There has to be a third external inducement to get risk capital to go there. Otherwise, it may not go there at scale.
Interesting. And then I guess when you think about those different segments, you kind of came back from retirement, I guess, maybe more than once, but, to come into the single family space with Invitation Homes. And, I'm curious what spurred that move, and how did you think about, the segment of housing you were gonna invest in?
Yeah, well, just like the rest of my career, I didn't think about it at all. It just happened. So yeah, I retired because I could have stayed on a lot longer at EQR and clipped coupons. I was having a great time. All I ever did was walk, travel around the country and talk to people and try to get them motivated. And I would do the earnings calls once a quarter, and I'd go to all the shareholder meetings and all the conferences and all that stuff. It's a good deal. So I didn't have to do any work because I had an excellent team, and they're all hard charging, a lot younger than you were at the time and was at the time, and a lot smarter and better than I was. So, but I could have hung around. But I learned a important life lesson from my other mentor, my boss there in the early days, Jerry Spector. He had my job, and I was like, damn, I want a turn. And he said, don't worry, you'll get your turn. And then I'd watch him, how he operated. I learned a lot from him. And then I started thinking, damn, I could do better. And then he left. And it shocked me. And he said, hey, I know you guys are ready. He said, I'm just not going to be the blocker. I'm not going to be the old guy sit around and just, drive you all crazy. And you're still climbing. I'm there. I don't need this job. So he retired to basically hand it over to the next generation. So I thought that, wow. And he's a dear friend of mine to this day. So anyway, that was part of my decision. And then I thought, I was living in Chicago. I was back in Chicago then, and excited to move to California, maybe for equity residential. And then I thought, damn, it's cold here. And I already had a home, in San Diego. So I said, shit, I'm gonna spend more. So anyway, and my grandkids were getting older. And so I just retired. That lasted about 6 weeks.
Oh, I didn't realize it was that short.
Yeah.
Okay.
Yeah, because I was at my home in Rancho Santa Fe, which is beautiful. I was just enjoying things, and I'd shave maybe twice a week, and I did all the grocery shopping. I was doing the laundry, and then my daughters would call me and say, "I got a spin class. Can you handle the kids?" And then they would call me and say, "I'm going to yoga class. Could you pick up this one at kindergarten?" And it's like, whoa, I like Mr. Mom. And I thought I need to find something to do. So I thought I'll buy homes, either fix and flip or build a little rental portfolio of my own. So I started going to these little home auctions. They were just getting started then, and I bid on homes. I kept getting outbid by these crazy people. I said, "Who are these people? They move fast. They're bidding high, and they're winning all the deals." So I was thinking about that, and then unbeknownst to me, I get a phone call, and they said, "Hey, Tom Barrick wants you to come up to LA and talk to him." And I don't know if you know Tom Barrick or not, but the chairman of Colony Capital, and they were one of the first three to go institutional, investors to go into single family rental big time after right in the end of the financial crisis. And that's a whole nother story we could spend 2 hours on. But anyway, I went up there to see him, and he told me what they were doing. And I was going like, "Oh man, what a I don't want to say shit show, but it was basically that. He's like, wow, this is chaotic. He said, yeah, we're already buying homes. I've got people all over these towns who were like financial analysts here in the office. We just gave them a hand truck full of cashier's checks and told them to go to Atlanta and buy homes. And they didn't know what they were doing. And they would keep a spreadsheet or a piece of paper, all dysfunctional. And he said, yeah, we've already bought like 3,000 homes. And they didn't know what to do with them. No management. I said, oh my God. He said, well, what should we do? I said, well, you need order. You need to run a railroad here. You can't just buy a bucket of assets. You have to operate them, because his plan, he told me his plan was long-term ownership, improve the performance, provide stable housing, and produce income for income investors in perpetuity. So I said, well, to do that, is this exactly what we did in the apartment business, because the apartment business was, decentralized, fragmented, unprofessional, not coordinated when I got started. So I said, deja vu all over again. You need somebody who's been there, done that. You need somebody like me who's willing to do it. He said, well, what about you? I said, oh. Okay. So I told him I would do it for a year. Then it ended up being like 7 or 8 years or something like that. I don't know. So we got started, and it was hilariously chaotic, but also a ton of fun. I got to hire all the people. I got to hire I hired apartment people, because they know what to do every day, every week, every month, every quarter, every year. And we built a railroad, and we built technology, because there wasn't any plug and play technology between multifamily and single family. So guess what? We had to build technology, but with the technology tools that we had available then versus 20 years ago, so much easier, so much better. We built it native internet, native mobile, high-speed development and deployment. And we built a fantastic platform of all types within 3 years. And we grew like crazy at the same time while we're building it. So we built Colony American Homes. It was called, from basically zero to about, 20,000 homes, something like that. And then we merged with Barry Sternlicht, who I knew from the early days at Equity Residential. We merged with his single family, which is called Waypoint Homes, and went public. And then that public entity operated as Starwood Waypoint. We grew to about 33,000 homes. And then all along, Blackstone had Invitation Homes that started as Treehouse Communities. And I knew John Bartling because we bought a big portfolio from him at EQR years ago, and a good friend of mine. And so we were very friendly, and we compared notes. We talked about a transaction a few times, couldn't get together. So then they went public. So then we were the two public companies. And then American Homes for Rent, which was Wayne Hughes, the guy who invented Public Storage Company. They were the other big one. So and then we created the industry council, the three of us. And then it went on from there. And we did the big merger, which is a whole nother story too. It's fascinating. When you have John Gray from Blackstone, Barry Sternlicht from Starwood, and Tom Barrick from Colony, in a room trying to negotiate a three-way merger, basically. Well, two of it already completed, but they were still involved. And people said, "Oh, those three guys, those egos are too big. It'll never happen." Well, within one afternoon at a meeting in Blackstone in New York, we got it done. And we announced it actually in about 3 weeks later, and then closed like 3 months later after that, creating the new behemoth, Invitation Homes, 83,000 homes, $22 billion market cap. And I was blessed with the opportunity to be the CEO of all those companies. And then I retired again. And now I'm even busier, but I'll never have another full-time job. I'm just having too much fun creating my own chaos, doing different things.
Wow. I mean, it's crazy how quickly the accumulation kind of phase was from, I mean, not zero, but relatively small scale institutional ownership of single family homes to, nearly a portfolio of 100,000 in, almost less than 10 years. I mean, how much structure was there along the way? Or, I guess what allowed that to happen?
Yeah, from zero to about 10,000 homes, there wasn't much pressure. But back then, you were literally drinking from a fire hose. We would send, this is no exaggeration, a crew of like 3 or 4 people to every major city on the day that they would have the courthouse steps auctions of these foreclosed homes. And you had to pay. People say, oh, these institutions stole the homes from the retail buyer. They should have been buying these foreclosed homes. No, that is absolutely baloney. To buy a foreclosed home, do you know what that means? In a situation like that, after the financial crisis, these homes were destroyed. A lot of them had no windows. All the copper was ripped out. Appliances gone. Holes in every wall. Just trashed. And there would be some unthinkable, unspeakable things that we'd find in them. And guess what? You had one day to decide whether to buy that home. You could not get inside. You were not allowed to go inside the home. You had to view it from the street. And you had to pay cash the next day. How many families with a husband, wife, and 2 kids can do that or should do that? It would be irresponsible. It'd be impossible and irresponsible. So no, we didn't steal homes from the and the banks had to get rid of these assets because the regulators of the banks don't let them hold those kind of unrelated, unverifiable in the value and random assets. It's toxic to the banks. They had to get rid of them. So we were the market clearing force, and they were attractive nuisances to the neighborhoods. These were dangerous. People were squatters were living in them. You had crack houses, meth houses, criminals that living in them, just vagrants living in them, who knows what living in them, animals living in them. And the neighborhoods, a lot of times on one street, there'd be like 6 of them. And then you all of a sudden you have your family there with your kids going up and down the sidewalk, and you don't know what's going on in those homes. And the grass was never cut, and they were just in shambles. So so I guess to answer your question there, we would send legions of people out with literally millions of dollars of cashier's checks. It's like Monopoly. Okay, here's a box of 50,000 denomination. Here's a box of 25,000 denomination. Here's a box of 10. Here's a box of 5. And then you'd bid on these homes pretty much blindly. But it was like 10 cents, 15 cents, 20 cents on the dollar of the potential value of the thing. So yeah, you made some mistakes. You had some, that were not salvageable. You'd have to get rid of later. But there's a lot of value creation there. So, and then we'd be standing there making a bid. Blackstone would be standing next to us. American Homes for Rent. So, and so it was easy to buy 1,000 homes a week, 500 homes a week, and we did that for many, many months. And but then once you start getting scale, and then there was no real great systems. Yeah, we had some systems, but they were cobbled together, and I couldn't say it was a well-oiled machine, but it was workable. And then we got better and better and better and better. It built systems behind as we're going, kind of as the airplane was flying. And then we realized that we were actually doing good because we're taking these nuisances off of the street. And all of a sudden we fixed the roof, all new appliances, fixed all the holes, put in new plumbing, new air conditioning. Fix the garage door, or replace it, fix the landscape, cut the grass, plant flowers. And then most importantly, put a family in there who could afford the rent and who could not afford to buy a home. And then we basically repopulated a big section of these cities that had gone abandoned.
Yeah.
So, and then other people say, well, you caused the foreclosure crisis. No, we never had any mortgages. We were management companies that were cleaning up the mess created by those dangerous mortgages that were put in mostly by government stimulated programs to stimulate home ownership beyond the point where it should have been. So it's all nature. Things always come back to the norm. So anyway, we were that servant to society, the way I view it. And then because it's so hard and so risky and so dangerous, we deserve to be paid for it. Risk reward.
Yeah, I think it's easy to underestimate how much work you were probably having to put into these homes. What was the percent of capital that you spent on the houses versus the improvements and renovation projects? Was it 50-50? Or?
Back then, well, it depends. Every now and then you get lucky, it might be 50-50. But typically, especially in the heyday of those, when you're buying nothing but foreclosures, during that time when that lasted, you'd pay 40,000 for a house, 35, maybe 50. But you'd have to put anywhere from 40 to 50 to 100,000 into it. And then you would end up with some in your portfolio that were, uninhabitable. Those were not worth fixing. You buy one that you didn't have an easement for a driveway, so you couldn't get to it. We saw all sorts of things. Or all of a sudden there was a duplex where you thought it was one home, and it's, but then also you'd have squatters. You say, hey, someone's living in there. There's locks on the door. And sometimes there's no utilities turned on, but people living in them. And then you knock on the door and say, we own this home now, you need to move out. And then they say, no. And sometimes they would stay there a year, through the legal process, trying to get them out. So anyway, it was not for the faint of heart, but it was necessary. Somebody had to do it. Otherwise, what's the alternative? Homeowners couldn't have bought these homes. Yeah. And then they would just be sitting there. And parts of Detroit were kind of like that, because even investors early days wouldn't go to Detroit. And it was horrible. It looked like they'd been carpet bombed, entire neighborhoods.
Yeah. In many ways, you're a developer. Your average homeowner isn't going to go redevelop a home from the ground up. And that's really what you were doing in a lot of these cases, it sounds like.
Yes. Yeah. Thank God we had Jay McKee was part of the early stages of Colony. He's now a very good friend of mine. He built this company called Vineyard Services. And he was the one renovating these homes for us. And he did it at scale, at huge scale. And he renovated more for all of us than anybody on the planet. He was doing thousands and thousands and thousands of complicated, large-scale renovations all throughout the whole markets, the Southeast and Southwest. And now today, Jay's doing it again. He's the founder and creator of a company called Lesson, which is a property services company at scale, not fully tech enabled, and doing some fantastic things. So it was it. But then that well went dry, and then things got more normal, and we would buy maybe 500 homes a month instead of 500 homes a week, and then we were buying them off MLS. Yeah. And then small portfolios, and then we started the build to rent, scattered site and contiguous, and so we did our strategy was to have a multi-channel acquisition strategy. We picked the markets, and then in those markets, pick the neighborhoods. And in those neighborhoods, we'd have a multi-channel strategy. You buy foreclosures, you buy MLS, you buy off-market, you buy portfolios if you can find them. It's still tough even to this day. And then, or you build. So, and that's true today. You do all of those.
Yeah, if I think about kind of what we have access to today in terms of software and tools, and even things that you might take for granted, like how easy payments, just processing payments are today. It's clearly evolved a ton over the last 15 years. I'm curious, if you think about what the opportunities were at the start, of that business and getting into single family, where do you see things headed? Do you see more opportunity in the single family space, or, what do you see as those opportunities in the market today?
Well, the great thing about real estate, especially residential real estate, is there's always opportunity. And you have the herd mentality, and everybody does great, but everybody's affected by the market forces, at the same time. And there's always little niches that people find for entrepreneurs, so it's just a very great space for creativity and individualist. Because it's a necessity. I like being in a business that's a necessity of life, shelter. You can't download, a place to live. So you're not going to be technologically disrupted. And they're not making more land. At certain times they build way too many homes. Right now, we are not building anywhere near enough homes. So now you're in a market that is under severe shortages, which creates problems, but also protects, your income and your rent increases. But then you have the whole public policy, political risk, legislation. So you have to balance those things and do what's right for the world, but also get paid for the risk you're taking. So there's lots of opportunities out there still. in the public arena, which I was active in for most of my career, and I really love. I predicted this back, God, I think in 2014. I was speaking at a conference in New York, and Green Street, one of the most respected, analyst and research companies, was the moderator, and I told them that they asked me that question. I said, well, at some point, you won't have single family, multifamily, student housing, seniors housing, and manufactured housing, all as in separate sectors. It'll be one, residential. Because if you look at the P&Ls of those businesses, they're virtually identical. All the income categories, the expense categories, the treatment of revenue, CapEx, all of it, same. Systems, very same. And nowadays with our sophisticated systems that we have, they're interchangeable and very flexible. So it's inefficient for the marketplace in the economy to have all that overhead applied to these businesses when it's not needed. And the economic theory says that over time, capital will flow to the most efficient use. So you think about it, you have all these separate public companies running these separate sectors with executives and systems and auditors and all this overhead dragging on the investment capital when it could be consolidated. So I think you'll see convergence of these residential into one sector called residential.
Interesting. And that's where the
Now,
real estate
hasn't happened yet.
Consolidating versus the real estate itself operating at the same margin.
Right. But now even to the individual investor, you could have very cost effective, basically on your coffee table at home system and operate single family rental, a small apartment building, short-term vacation rentals, a mobile home or RV community. You can run all of that. It's not as foreign as if you're running that and it's like, oh, here's an industrial building, here's a data center. Put that in your portfolio. You're like, oh, I don't know what to do with that. But the other ones are very familiar. And a lot of times you share the consumers on the consumer journey. Between age, life cycles, or stage of life, or stage of employment. So there's a lot of synergies to someone's life too. And then at the end, maybe we should own cemeteries. I don't know, or crematoriums.
Yeah. I'm keeping an eye on the chat here. Amy had asked a question about the short-term rental market. And I know you mentioned that briefly. You also recently joined the board of OnStay. I'm curious what you can tell us about that decision and any thoughts you have on the short-term rental market.
I love the short-term rental market. And again, I observed how my kids go on vacation because my kids are in their 40s, and they travel in packs. They've been doing that for years. Like it's not like, just me and my husband want to get away without the kids. They bring the kids, and then I get that, not totally, but I get it. But then they don't even go as their family. They go like, and our friends, so and so and so and so, whose kids are basically then that kid. We all go, and they don't go to a resort. They go to a killer resort home that none of them could afford on their own, but they pool their money, and the thing may rent for, I don't know, $2,000, $5,000, $10,000 a night, but they divide it across 4 or 5 families. It's doable, at different levels, but that's what they prefer. They don't do it because of the money, although that helps, but they can get a much nicer place they want to go, and they basically travel on a pack with their friends. So I thought, wow, that's pretty cool. I get it. So again, my friend Jay McKee, who I mentioned, when I was just retired the second time, we were brainstorming at a little office in Scottsdale, and he had already bought a couple vacation rentals right there in Old Town, Scottsdale. He said, I'm going to keep buying these things. And I said, that sounds like a really cool business. Let's do it. And next thing I know, control like almost every home on this little street right by the W Hotel, in Scottsdale. And then they started going up and up and up and up. He said, well, that's a cool business. And then he said, you know what? I see the services, laundry, cleaning, landscaping, security, turnover, R&M. So just like single family rental, I'm going to build a service company and service them. So that was the birth of Lesson. So I got interested in that business. And then I had the pleasure of meeting Sean Bruner one day, again, at a think tank thing in Scottsdale. I really enjoyed his energy. And he had this idea of this thing called Avant Stay. And then 2-3 years later, hook up with him again and said, wow. So I'm an early investor in Avant Stay because I just like the idea. And then the lodging business is more risky. And usually the thing is you don't want to be the first owner of a hotel. You don't want to be the second owner. You want to be like the third or fourth owner of a hotel. But in these things, they do have a second use. If you had to exit them, you can sell them as a second home. They're in destinations. So his concept is to not worry about where the neighborhoods are going to kick you out. These have to be compliant. And same thing with Jay's little portfolio. It was only in zoned lodging. So we're going to worry about getting crossways with neighbors or city councils. And anyway, it really took off. And he built a platform. He built a great service organization. And I just like that. The demand is incredible. Now, sure, all demand for this kind of stuff after COVID was all pulled forward. So it's a fool's game to take, that's my demand level, I'm going to grow it from there. No, it's going to come down. And it has started coming down, but not much. It's still above pre-COVID levels. And RevPARs are still above pre-COVID levels. So if you drew a line taking out the COVID pop, it's still very good growth. And the demand is great. Plus, I just love the product.
Yeah, it's a great experience. And I think, it's a little bit different as a housing product. You're really operating a hospitality brand, a hospitality business. The experience is really a big part of it.
Right. And I think the same opportunity is available. That's our strategy, is be in early, build a system, build a platform, build a brand, build scale, and then sell it. Either take it public or sell it to Marriott, Hilton, or who knows, or large PE shop.
Do you think that whether with Avant Stay or just personal opinion, do you think that the vacation rental space will continue to be primarily operated by individuals, or do you think that the institutional investment will come to this space at some point?
Institutional investment will come to the space, because that's a whole nother just economic theory. If you study economics, not real estate, but any business, capital always finds a way to go to the most efficient platform. It's not efficient for mom and pops to own businesses, at scale. And if you look at holistically, now, does it make sense to them? Yeah, if they get personal enjoyment out of it, they don't mind working and not getting paid for their hours, and they can take that appropriate amount of risk relative to their personal balance sheet, and they can build some wealth over time. That's the American dream, and everybody should do that who wants to do it. But also, economics, you can't deny of any. That's been proven since the beginning of time. Eventually, investment capital, demands the most efficient, productive use of capital. So is it productive for all these little mom and pops to operate all these businesses separately? No. The most efficient for a society is to have large scale ownership, efficient management, productive means and operations, delivery of a better product, and offer returns to public investors, which include personal investment accounts, IRAs, pension funds, teachers, firemen, pension funds, all invest in this stuff. So you'll see more roll-ups. I think roll-ups it's a fascinating concept. I watch the PE shops, the large ones and medium size. They're always looking for opportunities to find businesses, build a platform, scale it, and make it run collectively much more efficiently than the sum of the individual units left alone. That's the key. So you can do it with apartments. It's been done. You do it with office buildings. It's been done. Almost every sector it's been done. Now single family, it's not done because we have such a small sector. There's so much room for growth in SFR yet. You only have like 3 or 4 large companies. The combined market cap is maybe trillion or so. Compared to the value of the entire space, plenty of room for more. And then I know of companies that are rolling up dental practices. I'm working on one doing car washes. It's just it's a fascinating business play. So yes, single family rental. It's already happened to the manufactured mobile home park and RV park. Because myself and two other friends, after retired the second time, bought a couple in Phoenix. Love that business. It's needed. You talk about quality, affordable retirement housing, retirement communities, manufactured home, mobile home retirement communities is the answer for people who can pay $60,000 for a home and then pad rent. Very affordable and high quality communities. Anyway, the first one we bought, we got like a 14 cap. Second one we bought, we had to pay a 10 cap. And now they're trading for like sub 5 because large institutions have discovered it and they're coming in.
Interesting. Yeah, I mean, I think hearing you talk about just the fundamental nature of economies and thinking about how you've moved from kind of category to category, really you've kind of been opportunistic when there's an imbalance of supply and demand, or there's a new kind of technology or efficiency that's opening up supply or demand that's creating this wave. You've kind of been there at these different sector or segments of each real estate sector. It's kind of,
and we're not done. We're always innovating. And now I think maybe another horizon, this current environment we're in is to slow it down. But even within residential housing, single family housing, alternative forms of ownership is another whole developing trend. And I'm an investor in several of those ideas. Now, unfortunately, none of them have really scaled. And now we've hit the wall because of the current macro environment. But they still have some advantages. It's interesting that some of them have advantages to the consumer because this makes so much sense. But they had disadvantages in that raising investment capital to scale it is challenging right now. Anybody trying to raise equity or debt right now is kind of frozen. That's a whole nother discussion, but it won't last forever. It'll change. So alternative ownership models, whether it's co-living, co-ownership, rent to own, and then alternative ways of investing. The idea that Sam Zell had for REITs, he called it the liquidation. Wait, what's the word I'm looking for? Anyway, turning real estate into a liquid asset through public shares, where any Joe Blow can buy one share. Democratization, liquefaction of real estate. Fascinating concept when you think about it. So, what you're doing is providing a new alternative ways for investors to invest in the space without having to build a company or build systems or get the phone call at 10 o'clock on the July 4th, my AC's not working, and kind of low fuss, no muss, no direct contact, but I get investment exposure to the space.
Yeah, I think that brings up a good question that Lauren had posted in the chat, which was, when you think about you're an investor and angel investor in Arrive, thank you. And when you thought about that investment, what was it about the investing experience or the customer experience or product that you felt like there was a need that we were creating value, in this market?
Yeah. Well, I've invested in about, 22, 23 little prop tech startups in the last 3 years, and venture investing. Plus, I'm involved with some top-notch, VC firms. I'm a partner with Real Estate Technology Ventures. John Helm, I've known for 20 years, and they just have a fascinating concept. They're doing extremely well. And then I've done deals, kind of share deals back and forth with Khosla and with Fifth Wall, and then Spencer Raskoff with Sunny and 75. And so it's been fascinating, education for me. And then I've done a number of my own, but usually I get referrals from some of them, like, hey, you should check this deal out. And then people start calling you direct. But and I do this probably the wrong way. but it's my gut, and it's my own money, so I don't have to worry about it. Because if I was running other people's money, I wouldn't want to do it. It wouldn't be fun. I'd worry too much. But when it's my own money, I can take my own risk, and I can decide for whatever reason. Some of them rational, some irrational. So as I would get pitches from all these young entrepreneurs, my first inclination to do it would be based on that individual. You know, the energy, the vibe, the feeling, the passion, the work ethic, I could just kind of divine it from a Zoom call. I know it's dangerous, but I developed a sense for that. And then the business. So it was the person first, and the business second. But usually there's a relationship there if they're passionate about that business, or they have some reason in their history why they're bringing it forward and they're committed to it. You know, then I'm saying, you know what, this person deserves to get some capital to help them on their journey, and I'll go along with them. And I'm a betting man, because VC is a bet. You make 10 investments, you know you're going to have one success, a couple pretty good, one or two mediocre, and the rest are going to fail. It's just the way it is. But net in aggregate, it's a good business, or at least it's a fun business. So anyway, I'm saying, you know, that I'm gonna bet on this person and this idea. So I don't get out a calculator and calculate because all of the presentations were etherware. It's all just a PowerPoint presentation. It didn't exist. It was pre-business, pre-revenue, pre-EBITDA, pre-profit. And to this day, many of them are still pre-profit, pre-EBITDA. That's a whole nother discussion, but you got to keep the faith as long as you can. So I met Ryan, and pitch arrived. I thought, wow, you know, we just did this at scale, but we had the unfair advantage of unlimited capital. We could raise billions of dollars and not really have to work that hard to do it. Now, you had to have a track record, and you had to have systems, and it was a lot of work to get to that point. But once you get to that point, you have that momentum. You can issue more debt, issue more equity, issue more debt, as long as you're performing. You know that there's so much investor capital available in the world that like that strategy and like those returns. You have that access, and that's a huge advantage, especially in times like this, because you have the lowest cost of capital. Small entrepreneurs don't have that. But there's so much demand for SFR, and I know the untapped potential of the marketplace is massive. There's opportunities for everybody. There's massive opportunities for mom and pops, massive opportunities for, you know, publicly traded companies, and massive opportunities for everybody in between. What they need is connect them. Somebody who wants to invest in real estate, it's too much freaking trouble. I'm too busy. I don't want to do it. Or I don't want to invest in my hometown, and I don't know anything about that market over there. And I'm not going to travel if I get a phone call. So voila, build a platform, build technology. You're connecting, you're a connector, connecting opportunities with investors from all over the place of all different types at different levels who want access. So you're basically a conduit. And I love that idea. And I like the passion of the sponsors, and they had a nice, pretty PowerPoint with all the graphs go up to the right, and checked all the boxes. And here you are, still there today.
Great.
So
yeah, I think that.
So
I appreciate hearing some of the thoughts there, and thank you, Lauren, for the question. And yeah, I mean, just I guess real quick as we're going over here, I know that we had an hour with you, and thank you very much for making time available for us today in the middle of the home construction.
It's been fairly quiet. You're lucky. Earlier today, I was going like, oh God, I'm doomed. But
yeah, it's been great. Not too much coming through. And thank you so much for spending time with us, for answering questions with our investor community here. And I know they really value being able to learn from your experience, as do I. So thanks again for spending time with us today.
Well, my pleasure. I appreciate it very much, and thank you, and thank everybody for their interest. And hopefully you got something that you wanted out of it. I don't know, but if there's any follow-up, please let me know.
Yeah, absolutely will do.
Okay, great.
Thank you.
All right. I wish you all the best of luck, and all the investors out there, just hang on The good times are going to come again soon.
Thank you. All right. Thanks, everyone.
All right, thank you.